Hi everyone, this is Gerald from Beansprout. So over the past few months, we have seen the T-bill yield coming down. The latest cut-off yield for the 6-month T-bill is below 1.5%, which has led to a lot of questions around where can we park our cash to be able to earn a higher yield. Recently, I've seen a lot of discussion in the Beansprout community around the LionGlobal Short Duration Bond Fund, which is launching a new ETF class, making it the first active bond ETF in the Singapore market. So in this video, I will dive deeper into the bond fund. Do stick around till the end because I will also be answering some of the most frequently asked questions around the bond fund. And if you find the video helpful, do subscribe to our channel so you can get the latest updates on how you can generate passive income as well as grow your wealth in Singapore. So I'll dive right into the LionGlobal Short Duration Bond Fund, the active ETF SGD class. As a quick introduction to Beansprout, we provide financial insights to empower you to gain financial freedom and to retire happy. If you want to gain more insights, do visit our website, growbeansprout.com, as well as our various social media channels. A quick disclaimer before we start. The sharing is not tailored to your individual investment objectives and risk appetite and should not be taken to be financial advice. So there are a few things that we'll cover today. Number one, an introduction about the LionGlobal Short Duration Bond Fund, active ETF SGD class, where I will discuss some of the key features of the fund. Next, the question that many of you might have would be, what is short duration? Why do we look at short-term bond funds at this point in time? Last but not least, I will take some of the frequently asked questions that I've seen being asked about this particular ETF. For those of you who have not previously come across the LionGlobal Short Duration Bond Fund, these are some of the key features that we need to be aware of. So first and foremost, broader exposure. The fund consists of a portfolio of both Singapore and global bonds. It is actively managed by a fund manager, which in this case is LionGlobal Investors. As suggested by the name of the fund, it would invest in short duration bonds. Effectively, that would reduce the sensitivity to interest rate fluctuations. Last but not least, it is focused on total returns. And that is something that I'll explain in more detail around what we mean by looking at the total return of a bond fund. So one of the things that I'll always start with when looking at the bond fund is the fund fact sheet. So I've put out the latest fund fact sheet as of 31st July 2025. And from here, we can note some of the key features of the fund. So first and foremost, in terms of the portfolio holdings, 227 bonds. So by buying this bond fund, you'll be able to gain access towards a diversified portfolio of bonds. The weighted average yield to maturity is at 3.18%. And what this means is that for the existing bonds that are in the portfolio from 31st July 2025 to the time that the bonds actually mature, they are expected to offer an average yield of 3.18%. The next important number here is the weighted average duration, which is 2.25 years. What I will actually note of this 2.25 years is that effectively would be what the fund manager would mean by a short-term bond fund. So effectively, it is less sensitive to interest rate fluctuations compared to a bond fund with a longer weighted average duration. The next important point here is the weighted average credit rating, which is A- as of 31st July 2025. So when I'm looking at bonds, I want to know what is the risk of default of the portfolio of bonds. And what this average credit rating effectively tells me would be whether there is a high risk of default as determined by the credit agencies, or that there is actually a low risk of default. And based on this weighted average credit rating of A minus, it would be classified as having, on average, investment grade credit rating. The other key point I'll take from the fun fact sheet is the country allocation. And what I see here is that Singapore represents 40% of the portfolio. So for those of you who are looking for bond funds with a more sizable Singapore exposure, effectively, it might be important to know that Singapore represents 40% of the portfolio. In terms of the sector allocation, 36% in financials, 30% to real estate, which is probably not too much of a surprise given that a significant amount of corporate bonds, especially in Singapore, would be issued by companies within these two sectors. So here we can get a sample of some of the top holdings. I think what stands out to me is that there isn't any single bond that represents more than 3% of the portfolio. The largest one as of 31st July 2025 makes up about 2.7% of the portfolio. And that probably allows the bond fund to have a portfolio of 227 bonds. So looking down the list, there are probably some names that are familiar to you, including OUE REIT, Wing Tai, Ascendus REIT. We also see MAS Bill here. So effectively, that gives us a rough picture around what are some of the holdings of the bond fund. Okay, so what I'll look at next would be the historical performance of the fund. So while the ETF share class is something that is new, the LionGlobal Short Duration Bond Fund has been around for more than 10 years. Effectively, that will allow us to understand what the track record of the fund has been over the past 14 years. So what I can pick up from this is that the LionGlobal Short Duration Bond Fund has delivered positive returns in 13 out of its 14-year track record. Effectively, if I look at the past few years, 2023, the return was at 4.2%, 2024, 4.6%, and 2025 year to date, as of 31st July 2025, is at 3.5%. There have been periods where we saw a decline in the bond price. I think this was most recently in 2022, where because of the interest rate hikes by the US Federal Reserve, we saw the bond prices actually coming down across the board. And that actually led to a decline of the bond fund price by about 7.5% between September 2021 to November 2022. So this is one of the risks to keep a lookout for, which I will dive deeper into later, in that this is not something that is capital guaranteed. If interest rates were to move up, there is actually a possibility that the bond price will actually come down, which will then affect the net asset value of the bond fund. Okay, so this is another screenshot of the historical returns. We always say that past performance is not a reflection of future performance. What I can actually see here is that since inception, the bond fund has actually generated an average return of 3.7% per annum. And if I were to include some of the fees that were charged, then the average return per year is at about 3.5% per annum since its inception. That would exceed the benchmark of the bond fund, which is actually tied to the Singapore Overnight Rate Average, or SORA, plus 0.35%. So for many of us who invest in bonds and bond funds, we will look at the total return. But the other thing that might be of interest to many of you would be the distributions of the fund. So what we see here would be the historical distributions of the bond fund. And what I see here is that it has been making consistent distributions, effectively being made on a quarterly basis. And based on the latest data as of July 2025, the trailing 12-month historical yield is just slightly below 4%. Next, as investors, we need to understand how the fund manager actually handles the different aspects of risk. So in this case, I would consider currency risk, interest rate risk, as well as default risk. The first risk that I'll look at would be currency risk, especially with the very significant exchange rate volatility that we have seen in recent months. I think some of you may actually think about what is the currency risk involved for this bond fund. So earlier I showed that the portfolio would have a sizable part of the net asset value in Singapore bonds. But it is also worth noting that all non-SGD exposure is hedged back to the Singapore dollar. Next, we can look at the interest rate risk. So effectively, what I pointed out to earlier is that if the interest rate were to go up, bond prices may then come down, which would then affect the price of the bond fund. So in this case, this is where the short duration actually becomes important, because in this case, the weighted average duration of the fund is at 2.25 years as of 31st July 2025. So that makes the portfolio less sensitive to interest rate fluctuations compared to long duration bond funds. The third one is default risk, which is effectively the risk that some of the issuers of the bonds may not be able to repay on the principal or the coupon. So earlier I shared that the average credit rating of the portfolio is at A-, which would be an investment grade portfolio of bonds. So what we see here is that the maximum high yield exposure is at 5%. The maximum limit towards any high yield single issuer is 3%, and any single investment grade issuer is at 5%. So I've shared a bit about the LionGlobal Short Duration Bond Fund. What is important to note is that it is now available as an ETF. For those of you who might not be familiar with an ETF, that actually stands for Exchange Traded Fund. And as the name suggests, it will be exchange traded after it gets listed, which means that you can buy or sell the ETF through a brokerage account, given that it will be traded on the stock exchange. So some of the key points to note here, the target listing date is on the 29th of September 2025. It will be traded in both the Singapore dollar as well as the US dollar, with the SGX code SBO for the Singapore dollar ETF and SBV for the US dollar ETF. One of the key things that stands out to me here is the distribution policy of the ETF, where the fund manager has stated that they intend to make a distribution at the end of every quarter on or around 31st March, 30th June, 30th September, and 31st December of every year. I would also be keeping a very close lookout for the fees of the ETF. And what I see here is that the management fee is at 0.25% per annum. We will make a comparison later around the management fees of the ETF versus the unit trust. But before we go into that, you might be wondering what is an active ETF. So earlier I explained what an ETF is, and I think for many of us, the perception of an ETF is that it is passive, in that it just tracks an index without actually trying to achieve a higher return compared to the index. In this case, as an active ETF, one of the key characteristics is that it allows intraday trading and real-time pricing because it is traded on the stock exchange. Next, cost efficiency. I mentioned the management fee of 0.25% per annum on the ETF class earlier, and that is actually lower than the management fee on the mutual fund retail share class. Last but not least, going into what I mean by an active ETF, effectively, it does not track any benchmark index, and that also gives it room to potentially outperform the broader market based on the selection of bonds by the fund manager. So this is a side-by-side comparison of the unit trust with the active ETF SGD class. So what stands out to me from this table is that the management fee on the Class A unit trust is at 0.5% per annum, while for the ETF, it is at 0.25% per annum. I mentioned earlier that for the ETF, there is intraday trading, which compares to the unit trust, where there's no intraday trading and the orders are processed at the end of the day. In terms of access towards these two products, for the unit trust, it is traded through the distributors, while for the ETF, it is traded on exchange via any broker that allows trading of SGX-listed ETFs. So having gone through the key features of the ETF, the question that you might have at the back of your mind is that why should we consider short-term bonds at this point in time? So looking at the macro environment, one of the key drivers that many investors are looking out for is the US Federal Reserve interest rate decision. There are increasing expectations of interest rate cuts by the US Federal Reserve, which is one of the factors that is driving the lower government bond yields. So looking at this chart, which is the CME FedWatch 2 as of the 15th of September 2025, what we see here is that into the upcoming meeting on the 17th of September, investors are pricing in close to 100% probability that we'll see a rate cut in the upcoming meeting. Apart from that, we will likely see a potential further rate cut in October and potentially another one in December, which would actually bring the US Federal Reserve target interest rate to a much lower level compared to where it is today. So this has translated to lower US government bond yields. This is a chart of the US 10-year government bond yield. And what I see here is that the latest yield is at about 4.1%, having come down from close to 4.6% at the start of the year. For many of you who are investing in the Singapore T-bill, you're probably aware that the yield has come down very sharply as well. The latest auction as of the 11th of September saw the cut-off yield being at 1.3%. So this represents a fairly sizable decline compared to where it was at the peak, where it was at above 4%. So at Beansprout, we track the best fixed deposit rates, best savings account interest rates, as well as the T-bill yield very closely. And what I've observed in the past few weeks is that the interest rates have been coming down as a reflection of this increasing expectations of interest rate cuts. If you'd like to find out more around what is the best fixed deposit rate, best savings account interest rate, do watch our other video on where to park your cash for higher yield as of September 2025. So with interest rates coming down, we have seen bonds coming back into the spotlight for investors once again. That is because we have typically seen bond prices and interest rates moving in opposite directions, which means that when interest rates come down, bond prices would typically tend to move up. However, there are a few different things that we need to be aware about investing in bonds. And first and foremost, longer-term bond prices are typically more sensitive to interest rate changes. Okay, the other point that I'll also note is that bond yields may move by different extent with interest rate cuts. So I will discuss these concepts in more detail so that we are all aware around what are the key things to keep a lookout for when investing in bonds or in bond funds. So for those of you who are new to investing in bonds, this is a picture that I want to be able to bring up and share with you this concept around how bond prices and interest rates tend to move in opposite directions. Okay, so once again, when interest rates move down, bond prices typically tend to move up. Why is that the case? Because when interest rates fall, the new bonds that are then being issued would have lower coupon payments. And what this means is that for existing bonds with higher coupon payments then become more appealing to buyers, and that would usually drive the price of existing bonds up. The next question that you might probably have is then, what do we mean by a short-term bond fund? Why do we need to know what is a short-term bond fund versus a long-term bond fund? This is where the concept of duration actually comes in, because what this effectively tells us would be how sensitive the bond price is to changes in the interest rate. So I'll explain this concept using the Singapore government bond prices. So what I've done is to put into a chart the price of the Singapore 30-year government bond with the price of the Singapore 10-year government bond. So as we can see from this chart, with the fall in the interest rates over the past few months, the price of the 30-year bond has moved up by a more significant extent compared to the price of the 10-year bond. This would also mean that the 30-year bond price is more sensitive to interest rate changes compared to the price of the 10-year bond. So to recap once again, if it is shorter duration, the bond price is then less sensitive to interest rate changes, while if it is longer duration, then the bond price typically would be more sensitive to interest rate changes. The next question you might have would be, what are the risks relating to investing in bonds or bond funds? So two of the key risks that I'll be keeping a lookout for would be credit risk, which in the case of the LionGlobal short duration bond fund is that it invests largely in corporate bonds. So while I shared earlier that most of the holdings are investment grade and the portfolio carries an average credit rating of A- as of 31st July 2025, the corporate bonds still carry the risk of credit downgrades or defaults. Next will be the concept of interest rate risk, which is once again, if the interest rates were to rise sharply, then bond prices in the portfolio may still fall even if it is short duration. Now, going to the last part of my presentation, I recently did a SGX Academy webinar on the bond fund. And I've seen quite a number of questions being asked at the webinar. So I will take this opportunity to answer some of the most frequently asked questions. If you have got any further questions about the bond fund, do leave a comment in the YouTube video, and I would try my best to be able to help answer them. So one of the questions that I see commonly asked is how to buy the LionGlobal Short Duration Bond Fund Active ETF SGD class. So as shown in this slide, it can be accessed during the IOP period through the strategic partner or other participating dealers that are listed here. Next, I also saw questions around whether the ETF can be purchased via SRS. So I think it is important to note that during the IOP period, we cannot actually buy the ETF via SRS. But after its listing on 29 September 2025, the ETF will be listed on the SGX and available via brokers with SGX market access. After the listing, the SRS can then be used to invest in the ETF. Next is a question around, can you buy the LionGlobal Short Duration Bond Fund Active ETF SGD class via CPFOA? So the answer is that CPFOA can't be used to buy the ETF, as it is not yet 𝗵𝗵𝗲𝗃 approved. However, given that there is an existing unit trust for the LionGlobal Short Duration Bond Fund, the unit trust can be purchased using 𝗵𝗵𝗄𝗃. So to summarize, we have seen interest rates coming down with rising expectations of interest rate cuts by the US Federal Reserve. What we have seen is that bond funds allow diversified exposure to a portfolio of bonds, and some of the considerations that we need to bear in mind before investing in bonds or bond funds is to understand the yield that it can offer, what is the portfolio of bonds that it holds, as well as the average duration of the portfolio of bonds, which measures how sensitive the bond price is to changes in interest rates. It is important to note that bond funds are not capital guaranteed, and some of the key risks include credit risk as well as interest rate risk. For those of you who are considering between the LionGlobal Short Duration Bond Fund, active ETF SGD class versus the existing unit trust, what we have seen is that the ETF offers lower management fees compared to the unit trust. So that is my sharing on the LionGlobal Short Duration Bond Fund. I hope you found the video helpful, and do give us a like because that will provide a lot of encouragement to myself as well as the team. If you have any questions about the bond fund or the ETF, do leave a comment in the video and we'll try our best to be able to answer these questions. Thanks so much for watching, and I'll see you in our next video.